Welcome back to the XRP Reality Audit. Now that the Clarity Act has cleared the Senate Banking Committee with a definitive 15-9 bipartisan vote, the macro ledger has shifted. We are moving out of the legislative anticipation phase and directly into the structural implementation phase. Today, we are auditing the hidden wiring of the global banking system, specifically the upcoming real-time gross settlement deadline that forces Tier 1 financial institutions to replace legacy correspondent banking pipelines with mathematical finality. While the retail market is celebrating a political vote, institutional desks are calculating the exact date when holding dry capital becomes a regulatory liability. The pivot is no longer a policy debate, it is an infrastructure mandate. Let's address the true anchor of global finance, the shadow banking friction that regular retail trackers completely miss. When we talk about shadow banking, we aren't talking about illicit activity. We are talking about the multi-trillion-dollar unregulated liquidity markets, Eurodollar pools, and overnight repo desks that keep global trade alive. Right now, these markets are choking on interest rate volatility. In a high-rate environment, the time it takes for money to travel between jurisdictions isn't just a minor inconvenience, it is an expensive operational drag. If a sovereign wealth fund or a multinational bank has $50 billion trapped in transit for 48 hours, they are losing millions in potential overnight yield. This is the structural vacuum demanding instant velocity. To understand the solution, we have to look at the difference between traditional messaging protocols and native digital asset settlement. For decades, the financial world relied on the SWIFT network, but SWIFT is not a payment system, it is a text messaging platform. It simply tells Bank A that Bank B owes them money, requiring a massive web of pre-funded Nostro and Vostro accounts to actually clear the transaction days later. This is the wooden crate era of value transfer. The systemic pivot occurs when the messaging layer and the settlement layer become the exact same step. When you utilize the XRP ledger, the communication of the transaction is the delivery of the asset. The value moves at the speed of the data packet, entirely erasing the need for idle capital silos. The institutional banking lobby spent years fighting this evolution because their business model relies on charging a toll at every single junction of the legacy pipeline. Foreign exchange spreads, correspondent clearing fees, and administrative delay charges represent billions in pure risk-free revenue for Tier 1 gatekeepers. However, the efficiency trap has officially closed on them. The cost of maintaining these manual, fragmented ledgers has grown larger than the profits they generate from the friction itself. As global liquidity tightens, central banks are demanding a system that operates with absolute mathematical certainty. The legacy institutions didn't choose to adopt a neutral bridge asset out of altruism. They are adopting it because the math of survival gave them no other choice. This brings us directly to the production integration of the XLS80 protocol on the XRP ledger. While the public space is saturated with speculation about retail trading apps, the actual institutional volume is migrating toward automated market maker structures built specifically for tokenized real-world assets. In video 3, our audit focus shifts to the private credit markets. When a commercial paper contract, a real estate deed, or a sovereign treasury bond is tokenized, it requires a highly liquid, non-sovereign bridge asset to facilitate cross-border exchange without introducing counterparty risk. XRP was engineered precisely for this function. It acts as the universal adapter, allowing a tokenized asset in Tokyo to instantly settle against a liquidity pool in New York within 3 seconds. We must analyze the exact mechanics of what happens when the legal stop signs are removed by the impending floor vote of the Clarity Act. Right now, institutional capital is building up behind a legislative dam. The $1.5 billion currently sitting in US-based spot ETFs represents merely the tip of the spear. The true institutional weight exists within the corporate treasury departments that are legally prohibited from holding digital commodity assets without a formal act of Congress. The moment the Clarity Act passes the full Senate floor, that restriction evaporates. The resulting influx of capital will hit a public exchange supply that is currently sitting at multi-year lows. This is not a standard market cycle. It is a structural supply squeeze. As we close part 1 of this masterclass, remember the baseline rule of the reality audit. Follow the plumbing, ignore the propaganda. The financial system is transitioning from an era of permissioned friction to an era of automated liquidity. The gears of the old model are grinding to a halt, and the digital grease is about to be poured into the machine at a macro scale. In part two, we will break down the precise cross border repo data from the first half of 2026, the specific settlement deadlines facing European clearinghouses, and the exact price compression bands we are tracking as the June deadline approaches. Prepare your project timeline. The systemic pivot is officially underway. To map out the execution roadmap for this systemic pivot, we have to look across the Atlantic at the European clearinghouse deadlines. While the United States has been mired in legislative debates over the Clarity Act, Europe has been quietly hardening its digital infrastructure under the updated MyCA framework. By the end of this quarter, European Tier 1 institutions face a mandatory hard deadline to transition all cross-border, high-value settlement systems to real-time gross settlement rails. The old method of letting transactions sit in a clearing queue for hours is no longer legally permissible. This creates an immediate operational crisis for banks operating between London, Frankfurt, and New York. They must find an instantaneous settlement asset that satisfies strict European capital reserve requirements without forcing them to hold massive, volatile fiat reserves. The traditional response to a clearing deadline would be to utilize central bank digital currencies, or CBDCs. However, the 2026 data shows a massive flaw in that strategy: fragmentation. A digital euro cannot natively settle on a digital dollar rail without a trusted third-party intermediary, which simply introduces the exact same correspondent banking friction we are trying to escape. This is where the neutrality bridge comes into play. European clearinghouses aren't adopting XRP because they prefer it over sovereign currency. They are adopting it because the math of a decentralized ledger provides a neutral territory. It allows a European bank to offload euros, settle the bridge transaction in 3 seconds, and deliver US dollars to the destination ledger without either central bank having to build a direct pipeline to the other. Let's audit the cross-border repo market data from the first half of 2026. The repo market is the foundational engine of global banking liquidity, where institutions trade trillions of dollars in high-quality collateral overnight just to meet their daily regulatory reserve balances. In the current high-yield environment, the velocity of this collateral is everything. Our audit of on-chain treasury tokenization reveals that over $800 million in sovereign debt obligations are now being mirrored onto the XRP ledger using the XLS80 protocol. This allows these massive institutions to borrow against their bond portfolios instantly, executing overnight repo agreements in seconds rather than waiting for the legacy wire systems to open the next morning. The grease is already working in the shadow banking sector. The banking lobby's primary argument against this transition has always been the concept of price volatility. They claim that an asset like XRP is too volatile to be trusted with institutional settlement. But this argument exposes a deep misunderstanding of how high-velocity liquidity actually functions. An institution executing a multi-million-dollar cross-border swap does not care about the 24-hour price trend of the asset. They care about the 3-second execution window. When a transaction settles in 3 seconds, the risk of price slippage is statistically near zero. The efficiency gains found by eliminating pre-funded accounts completely outweigh any micro-fluctuation that occurs during a 3-second transmission. The legacy gatekeepers know this, which is why their public warnings are completely contradicted by their private infrastructure upgrades. We must also analyze the exact price compression bands we are tracking as the June Senate floor vote approaches. Following the 15-9 committee victory, a clear technical floor has formed. The retail market views this sideways consolidation as a lack of momentum, but institutional desks recognize it as a textbook absorption pattern. The daily exchange reserve data indicates that liquid supply is being systematically drained into permissioned liquidity vaults at a rate we haven't seen since the post-settlement rally of early 2025. When the public exchange liquidity drops below a critical threshold, the market loses its ability to buffer large orders. This means that when the institutional clearing demand hits the open market, the response will not be gradual. It will be a mechanical step up. The contrast loop is currently operating at maximum intensity. On one side of the screen, you have mainstream financial networks broadcasting legacy analysts who claim that digital assets have no place in institutional treasury management. On the other side of the screen, the data shows that the major global clearinghouses are actively updating their software packages to integrate with the Interledger protocol. This intentional divergence is designed to keep public retail sentiment suppressed while the final allocations of the tokenized repo pools are secured. If the public fully understood the regulatory mandates facing European banks this quarter, the available supply on public exchanges would vanish overnight. Your edge as an auditor depends entirely on your ability to read the technical deadlines rather than the media headlines. The timeline is locking into place. The European clearinghouse mandates create a definitive operational deadline. The repo market data confirms that institutional adoption is already scale ready, and the price compression bands indicate that the available supply is being tightly wound. The systemic pivot is a dual engine machine driven by legislative victory in the US and infrastructure necessity in Europe. We will dive deeper into the specific architectural mechanics of the XLS80 liquidity pools, the exact calculation of the institutional floor price, and how the tokenization of private credit is permanently shifting the velocity of money. Update your project files. We are moving directly into the core data audit. We now enter our audit, the structural mechanics of the XLS80 liquidity pools and the raw physics of private credit velocity. To understand where the price is going, we must first understand how value is stored within the network's architecture. In the old model of decentralized finance, liquidity pools were highly volatile, vulnerable to impermanent loss, and completely non-compliant with banking standards. XLS80 completely rewrites these rules for 2026. This protocol introduces institutional-grade, single-asset liquidity provisions with native compliance guardrails built directly into the ledger's engine. This means a commercial bank can plug its treasury capital into an automated market maker pool, earn a predictable yield on their idle reserves, and facilitate global settlement without ever exposing their balance sheet to unauthorized counterparties. Let's break down the exact calculation of the institutional floor price. Mainstream financial commentators try to value digital assets using equity models, looking at transaction counts or retail wallet growth. This is a fundamental analytical error. A neutral bridge asset utilized for real-time gross settlement is valued based on the liquidity density required to clear the largest daily transactional peak without causing price slippage. If a clearinghouse needs to move $10 billion in a single 3-second ledger bracket, the total available liquidity in that specific corridor must be deep enough to absorb the shock. Therefore, the price of the asset must naturally appreciate to expand the total dollar capacity of the pool. The floor price isn't speculative, it is a mathematical derivative of the system's required carrying capacity. The tokenization of private credit is the primary engine driving this new liquidity requirement. According to the latest Q2 2026 banking data, the traditional private credit market has ballooned to over $1.7 trillion globally. But this market is notoriously illiquid, with capital locked in opaque corporate structures for months at a time. By wrapping these private loans, high-yield corporate debt, and mid-market commercial paper into smart contracts on the XRP ledger, institutions are creating instant liquidity. A bank in London can now sell a fractionalized share of a corporate loan portfolio to an institutional buyer in Singapore, settle the transaction through an XLS80 pool, and receive usable capital in seconds. The velocity of money is accelerating from a crawl to supersonic speeds. This acceleration of velocity creates what we define as the liquidity vacuum. In fluid dynamics, when you pull a liquid through a pipe at high speeds, it creates a low pressure area that sucks in everything behind it. The exact same principle applies to global capital. As the velocity of tokenized private credit increases on-chain, it creates an intense structural pull on the remaining liquid supply of XRP sitting on public exchanges. The institutional pools require a constant influx of the base asset to maintain their balance ratios. The data confirms that this structural pull is completely independent of daily retail trading volume. The vacuum doesn't care if the retail market is bullish or bearish. It simply demands supply to fuel the automated settlement engine. We must address the concept of sovereign coexistence. A common narrative pushed by skeptics is that central bank digital currencies will completely eliminate the need for independent digital assets. But our audit of the current cross border architecture proves the exact opposite. Sovereign nations will never fully trust each other's centralized digital ledgers. The Federal Reserve will not run its internal systems on a digital yuan rail, and the People's Bank of China will not settle its sovereign debt on a digital dollar network. The global financial architecture requires an entirely independent, neutral, decentralized settlement layer that belongs to no single nation state. XRP functions as the demilitarized zone of international finance. It is the common ground where competing sovereign interests can settle value with absolute finality. Look closely at the contrast loop playing out across the institutional landscape right now. While prominent bank executives make media appearances warning about the structural risks of decentralized networks, their own technological subsidiaries are actively securing patents for automated ledger routing. They are publicly downplaying the asset while privately building the infrastructure to monopolize its distribution. This is a classic asymmetric accumulation strategy. They need the retail public to remain distracted by short term price fluctuations and political theater while they lock in their long term liquidity allocations through the XLS80 architecture. The data doesn't lie, but the mouthpieces do. The picture should be undeniable. The XLS80 protocol isn't just an upgrade, it is the construction of a brand new financial highway. The floor price is rising because the required liquidity density is expanding. Private credit tokenization is driving the velocity of money to historic highs, and the need for a neutral sovereign bridge asset is a physical law of a multipolar world. The structural pivot is entering its final operational phase. In part 4, we will transition into the specific execution timeline for the upcoming June Senate floor vote, the hidden countermoves being prepared by the banking lobby, and the exact risk management parameters you need to establish before the liquidity dam breaks. Keep your focus tight, the audit continues. The banking lobby's hidden countermoves and the specific execution timeline leading to the full Senate floor vote this June. Make no mistake, the 15-9 committee victory was a massive structural blow to the legacy gatekeepers. But they are not retreating, they are repositioning. The banking lobby is currently preparing a highly coordinated counteroffensive designed to dilute the operational power of the Clarity Act before it reaches the president's desk. Their main objective is to attach restrictive amendments to the bill that would limit the ability of commercial banks to directly interact with public liquidity pools like XLS80. They want the infrastructure, but they want it locked behind their own proprietary toll booths. Let's lay out the exact timeline we are tracking. Following committee approval, the bill is currently being drafted into its final legislative text by the Senate parliamentarian. This text will be formally placed on the Senate legislative calendar under general orders. We are tracking a tight window between late May and the third week of June, just before the congressional summer recess. This is the red zone. During this period, institutional trading desks will be pricing in the probability of a filibuster or a last-minute amendment battle. The data shows that institutional accumulation spikes every time a key swing senator releases a public statement of support. The timeline is compressed, and the capital markets are moving in direct synchronization with the legislative clock. The banking lobby's hidden weapon in this fight is a tactical maneuver we call the yield conflict. Right now, traditional commercial banks make a massive portion of their revenue by capturing the spread on your dry capital. They take your deposits, pay you less than 1% interest, and lend that same capital out into the overnight repo markets, or buy short-term treasuries yielding over 4%. If the Clarity Act codifies a framework where corporate treasuries and retail investors can bypass the commercial banking layer entirely and access institutional yield directly through automated on-chain pools, the traditional banking business model collapses. This isn't a debate about consumer safety. It is a direct war over who controls the yield of the global economy. To counter this threat, the legacy institutions are funding a massive media campaign designed to create artificial panic around systemic stability. They are instructing their captured media mouthpieces to run headlines claiming that real-time gross settlement via digital commodities will cause structural bank runs because capital will move out of traditional bank accounts and into the ledger at supersonic speeds. But our audit of the systemic architecture reveals the fundamental hypocrisy of this narrative. The very same banks warning about on chain bank runs are currently building private, permissioned routing nodes on the Interledger protocol. They don't want to stop the flight of capital. They want to make sure that when capital flees the old system, it lands inside an infrastructure they control. This brings us to the critical risk management parameters you must establish before the liquidity dam breaks this June. In a structural pivot of this magnitude, volatility is a double edged sword. As we approach the full Senate floor vote, the market will experience intense liquidity pockets. This means we will likely see massive artificial price flushes designed to shake out over-leveraged retail positions right before the final vote occurs. The institutional desks use these engineered liquidations to sweep up cheap spot supply from public exchanges to pre-fund their XLS 80 pools. If you are operating with high leverage or trading based on short-term hourly charts, you are playing directly into their accumulation script. Observe the contrast loop in full effect on your screen right now. The mainstream financial press is saturated with articles questioning whether the Senate has the political will to pass comprehensive digital asset reform this summer. Meanwhile, the public blockchain ledger shows that 3 of the largest custody banks in the United States have just updated their wallet architectures to support native XLS80 smart contracts. They are telling you to doubt the legislative outcome while they actively construct the technical receivers to handle the post-vote capital flows. The public noise is the shield. The private deployment is the reality. The battle lines are clearly drawn. The banking lobby is executing its last-minute procedural counter moves. The June Senate timeline is ticking down with absolute precision, and the war over global yield has officially begun. The institutional game plan is to suppress retail participation through artificial media panic and engineered price volatility right up until the gavel falls on the Senate floor. In our 5th and final part, we will deliver the ultimate execution roadmap, including the exact technical triggers that signal the launch of the systemic absorption, the structural repricing targets, and your final operational checklist as an auditor. Keep your emotions locked down. We are entering the final deployment phase. We have reached the final part of our audit, the systemic absorption roadmap, and your final operational checklist as the June legislative deadline approaches. This is where the theoretical architecture meets the physical reality of the order books. Systemic absorption is the precise process where an asset transitions from an optional trading vehicle to a mandatory settlement utility. In the legacy financial system, this transition is called structural inclusion. When an asset is absorbed into the global plumbing, its valuation models must be completely rewritten. We are no longer calculating retail buy and sell pressure. We are calculating the total transactional volume of the international gross settlement networks that must be carried by the ledger every single second. Let's lay out the exact technical triggers that will signal the launch of this absorption phase. The first trigger is not the passage of the bill itself, but the formal publication of the Federal Register framework following the Senate floor vote. This is the moment the regulatory parameters are officially codified into banking law. The second trigger is the activation of the automated clearinghouse routing protocols within the XLS 80 liquidity engine. Our audit shows that once these 2 triggers fire, the flow of capital becomes automated. Corporate treasuries will not manually execute these trades. Their enterprise resource planning software will automatically sweep excess fiat balances into on-chain liquidity pools to eliminate overnight settlement drag. We must address the structural repricing targets that the institutional desks are using to backstop their risk models. Traditional market analysts keep trying to predict a specific dollar top based on historical chart patterns or previous retail bull markets. This is a dead methodology in 2026. The institutional desks don't look at charts, they look at slippage thresholds. If the global tokenized private credit market reaches its projected scale, a low-priced bridge asset would experience massive, destabilizing price swings during a standard multi-billion-dollar cross-border swap. To maintain a stable, predictable settlement corridor, the asset's dollar liquidity density must expand. The repricing target is simply the mathematical equilibrium point where the ledger can absorb a top-tier bank run without shifting the price by more than a fraction of a percent. This brings us to your final operational checklist as an auditor. Step 1. Isolate your capital from the public exchange leverage loops. The upcoming liquidity hunts will be violent, and their sole purpose is to clear the board of retail derivatives before the automated institutional routing goes live. Step 2. Monitor the on-chain escrow releases and the internal wallet migrations of the top 3 U.S. custody banks. These wallet movements are the true leading indicators of institutional readiness. Step 3. Stop measuring your portfolio value in short-term fiat terms and start measuring it in systemic allocation percentage. In a tokenized economy, your edge is determined by how much of the foundational rail you own before the access gates are permanently locked. Observe the final contrast loop playing out right now as we close this production block. Mainstream financial commentators are still running emergency segments debating whether the Clarity Act will face a last-minute filibuster or a presidential veto. Meanwhile, the public ledger reveals that the primary liquidity pools for the XLS80 protocol have just completed their final dress rehearsal stress tests with zero downtime. The political theater is operating on a tape delay, while the technical infrastructure is operating in real time. The system has already accepted the reality of the shift. The politicians are simply drafting the press releases to explain it after the fact. As we conclude this video, the data audit is complete. We have mapped the shadow banking friction, verified the European clearinghouse deadlines, calculated the XLS80 liquidity density requirements, and exposed the banking lobby's hidden yield conflict. You now possess the complete execution roadmap for the systemic pivot of 2026. The transition from speculation to necessity is an ironclad law of economic efficiency. It cannot be negotiated, it cannot be bribed, and it cannot be stopped by legacy gatekeepers. Stay disciplined, protect your allocations, and refuse to let the public noise shake you out of your institutional position. Thank you for completing this comprehensive audit. The infrastructure is built, the technical triggers are set, and the timeline is counting down to the June floor vote. I am Diana, and this has been the XRP Reality Audit. Make sure your notifications are locked in as we track the real-time movement of the global banking plumbing. The asset is moving from optional to required. Ensure your strategy reflects the math. The data vault is closed. I will see you in the next briefing.